Hello and welcome to this second economics teacher webinar focused on financial markets. In this session we'll be taking a closer look at what we mean by financial institutions and how they link in with the remainder of the economics syllabus, and therefore how students can use their knowledge to help develop those important synoptic skills that are required ahead of paper 3. Before we make a proper start, I just want to quickly draw your attention to our upcoming student revision workshops in a view cinema near you. We have Grade Booster for Year 13, Flying Start for Year 12. The session titles are available just there on the left-hand side of the screen. You can go onto the Tutor2U website to book places for your students, or they can book themselves on. It's completely up to you. Some of the events are already sold out, so I would encourage you to crack on and book if you think that you would like your students to attend. There are also some resources that we think you might be interested in. Our popular synoptic revision placemats are really helping students up and down the country to prepare for the synoptic paper 3. Volume 1 is already available. Volume 2 will be available very, very shortly. There's also the popular Economics Key Term Glossary containing all of the essential key terms, including those needed for financial markets. We also have model essay booklets currently at the printers and designers, which will hopefully be ready very, very soon. Essays on ranges of topics with lots and lots of examiner commentary to help students see their way through answering difficult questions and how to structure their answers. Just hot off the press as well, we have a range of AS Economics Revision crosswords all available now from the Tutor2U website to buy and download. The second year A-level revision crosswords will be available very soon as well, but we've got ahead and we already have one on financial markets. I will make sure that the link to that is provided towards the end of this webinar. So what are we going to be taking a look at today? Well, firstly, I think it's really important that we actually get to grips with and gain confidence in understanding what our students really need to know about financial institutions, as well as considering some approaches for teaching the topics. So the core areas I think can really be split into two halves. Obviously, there are the elements of financial institutions that fit within the actual financial market specification. I've listed them there in blue for the three major exam boards on the left-hand side of your screen. There is slightly more detail provided for OCR in terms of exactly what students need to know. EdXL teachers, no specific financial institutions are mentioned, but hopefully what this webinar will do will show you the key institutions that I think it's still worthwhile your students being aware of, because it allows them to access questions in different ways and really show off a wide range of knowledge. We mustn't forget that financial institutions are actually a key part of the development economic specification. When we look there, for example, at factors such as access to credit and banking, institutional factors limiting development, and even through to the concept of microfinance and international capital markets. So we can already see that there are very clear ways in which financial institutions are set out in the specifications. What I think is really important though is the more synoptic approach. And I'm just going to introduce sort of 6 or 7 ideas and places in which you can build in the idea of financial institutions into broader teaching. So firstly, how do they link with consumer spending or consumption as a component of aggregate demand, and the impact of those on long-run aggregate supply? Now, clearly, the availability of financial institutions allows people to save and to borrow, and both of those factors will influence consumer spending. Clearly, that filters through also into providing funds available for investment purposes, which can tie in not only with the investment component of AD, but also the addition to the country's capital stock, which therefore influences long-run aggregate supply. So a really clear link there with how financial institutions are important. We could also consider it in terms of inequality and poverty. So for example, the extent to which people have access to finance, and the effect that that therefore has on their living standards, their degree of poverty. Around 1.5 million adults in the UK are apparently unable to get a bank account. And clearly, if you think about how often you use your bank account in terms of being able to get a job, pay for housing, it's really, really important to have access to financial institutions. So there's clearly a link there with inequality and poverty. We could also consider the microeconomic angle here, for example, linking in with market structures. The major high street banks in the UK form a very, very strong example of an oligopoly. 5 key banking groups with around 85% market share. So that's quite obvious as well. But you could also link it in with your teaching on, say, contestable markets, as the role of technology makes online banking more and more easy. So some excellent links there for you to make. You could also step right back to the very beginning of your macro teaching and consider the circular flow of income. Now, most teachers seem to start with a very simple model, just connecting firms with households. So the provision of labour from households to firms allows output to be produced, it allows incomes to be earned, and it allows households to buy that output via expenditure. But obviously, as we expand the circular flow of income model and include governments, the international sector and the banking sector, we are clearly introducing the concept of financial institutions in terms of channeling money from households via savings through the banking system into investment by businesses. So a nice simple way, right back using some of the most basic macro knowledge of your students for connecting in financial markets. There's also the connection with the balance of payments. Now, clearly in the UK, this is really important. We attract a huge amount of interest from overseas in our financial sector. So we have a quite significant trade surplus on financial services, but we also attract a lot of foreign direct investment and hot money coming in as a positive on the financial account. Now, clearly that also allows us to finance the purchase of imports and run a current account deficit. So financial institutions are very important in understanding the balance of payments. We can also tie it in with the concept of labour market flexibility. So obviously access to housing is a key part of labour market flexibility. So therefore we're thinking about the ability to take out loans and mortgages, perhaps in terms of geographical mobility, thinking about the ability to take out a loan for a season ticket, for example. So a nice synoptic connection there. It's probably obvious that it links in with monetary policy. So, for example, quantitative easing by the Bank of England requires there to be financial institutions that can take the additional cash or money created as a result of QE asset purchases. And finally, and perhaps the most unexpected one here, I think, for most people, would be the link with externalities. Lots of financial institutions, particularly the investment banks, buy shares and help deal with bonds for companies that might generate negative externalities, for example, tobacco companies, oil companies, transport companies. So in effect, the existence of financial institutions, it allows those companies to operate, providing market goods and services, but it will also help to contribute to overproduction and generating negative externalities. So there are all kinds of ways there in which financial institutions are actually at the heart of many, many economic topics that you might be covering. Now, to that end, I think it might be worth having a little think about your schemes of work, particularly in light of next year's teaching and perhaps the second time through of the linear teaching. You might actually want to start with a basic understanding of financial institutions for your new AS students, because it is so relevant to pretty much everything that they will end up studying. So just one key thought there, perhaps rethink your scheme of work. The very basics in terms of what your students need to know are the very basic types of institutions. So retail and commercial banks, which provide the basic banking services of accepting deposits and providing loans. There are also investment banks, which can deal with foreign currency flows and exchange and providing the finance for investment. Some banks only fall into one of those categories, but there are banks that run operations across that whole range. So commercial banking and investment banking are the basic types of institutions that all students should be aware of, even if it's not specifically mentioned in your specification. But I think it's actually worth sort of taking a leaf out of the OCR economics syllabus for a moment and considering some of the other institutions. So one such institution would be pension funds. So the first bullet point here provides a brief definition and explanation of the role of pension funds. The second bullet point is where I think there's actually a lot more interest here and an awful lot more use for your students. So what I've tried to do there is link in pension funds with other areas of the syllabus that your students will be meeting. And as you can see, clearly the availability of pension funds improve living standards for people who are retired. So not only do you have a positive impact on living standards and potentially economic development, but actually that also works in terms of reducing the burden on the taxpayer for providing state pensions, which is critical really, where in situations where national debt is increasing. Similarly, insurance funds, which is specifically mentioned on the OCR syllabus, but most students should probably leave their A-level economics course with a bit of an understanding about what this is all about. Again, first bullet point, a brief explanation of that key term. And the second bullet point in green there, looking at how to link the concept or the existence of insurance funds into other areas of the course. So for example, by encouraging investment, basically insurance encourages people to take risks, set up businesses, for example, and that can improve confidence. That in turn can encourage investment, which obviously you then lead to increased levels of sustainable growth, perhaps more employment, and so on and so forth. Finally, hedge funds, which have been they've taken quite a bad hit in the media, but they do provide a useful service by actually providing different sources of income. So it's not just employment that can generate income, but obviously investing in funds such as hedge funds can, of course, have a positive impact on your income flow, and that in turn can influence consumer spending and investment, components of aggregate demand. So it can help to move an economy out of a recession. So it's worth really thinking about these terms and concepts and how they tie in synoptically with everything else that your students are studying. Now, financial institutions, like any business, we're going to assume that they aim to earn profits. These are some of the key ways in which they earn profits. And it's worth students just stopping and thinking for a moment about this and linking this in with their knowledge of theory of the firm. Now, clearly it doesn't really tie in very well necessarily with the marginal cost equals marginal revenue profit maximising condition. These institutions don't necessarily know if they are maximising profit or merely whether they are simply earning enough. We might want to think about how these firms use their profits. What do they do with them? What is the purpose of them? Linking in with the idea of, say, shareholders and really connecting in your teaching with the concept of the stakeholder. We might also want to think about inequality. For example, bankers being paid bonuses tied to profits and performance, and the impact that might then have on inequality in an economy. So there's all kinds of extra connections that you can make there. So overall, the impact of financial institutions, on the left there, we're really focusing on how they facilitate economic growth and development in a number of ways. Financial intermediation, in other words, channeling funds from savers or depositors through to borrowers. And that allows businesses to function and to grow and for households to smooth their consumption. And overall, that reduces the risks and difficulties associated with economic growth. Over on the right hand side, we've got some more macro links. The financial sector, particularly in the UK, contributes really heavily to employment and government finances. They allow monetary policy to operate, and they also allow us to facilitate international trade. So you can really see how we can connect in with all of the components of aggregate demand and all of the key macroeconomic objectives, which is why I think it's worth reiterating that perhaps providing students with an understanding of financial institutions before they start the A-level course properly might be a good idea if you're thinking about how to change your teaching and schemes of work for September. I also think it's worth just spending a few moments thinking about how to evaluate the role of financial institutions. If you've been joining me for some of the previous webinars on synoptic teaching and our very first financial markets webinar on money and central banking, you might be quite familiar with this acronym that we use at Tutor2U in economics called Going APE, in which evaluation is conducted by considering assumptions, different perspectives, and whether evidence supports or negates key arguments. So on the left hand side of the screen there is a little picture of a sort of average town perhaps. And these are what I call perspectives boxes. So I would often give students a short case study to read on anything. But in this case, you could find something about financial markets or just ask them to consider without a case study the role and impact of financial institutions on all of these different areas. So, you know, what relationship do rich families have with financial institutions compared with poor families? Do schools benefit in any way? How does the government benefit? How do small businesses benefit? So these perspective boxes can be really, really useful in your teaching and encouraging students to think about an issue from a range of different perspectives. It's also really important as part of the E bit of Going 8, the evidence bit, that students are able to spot developments in the market and tie it in with their economics. So I've just come up with 4 key categories here. And I think categories are actually really important in helping students to structure their thoughts. So I've had a little think about various developments in financial institutions and banking, and then thought about how I can categorise them. So my 4 categories are filling gaps in the market, or in other words, dealing with market failure. And in there, I've got the idea of crowdfunding, so access to finance and actually getting a sense of which ideas might work before you get the finance or not. Payday loans for the people who struggle to access the regular banking system. And microfinance and microcredit, particularly relevant in your teaching for development economics. But there are increasingly, there is increasing availability of such sorts of finance in the UK as well. The second factor there, rising contestability. The government has been really hot on this at the moment and trying to encourage people to switch their current accounts from one provider to another. So there is actually now the official current account switch service, but only 3% of households every year or personal current account holders actually switch their accounts. There's also the rise of challenger banks such as Metro Bank, who are making very good use of technology. I've also thought about globalisation and the ethical side of banking, and just generally cool tech. So instant payment via smartphones, what does that do to the need to hold cash, for example? And peer-to-peer apps where people can lend directly to people without going via a financial institution. So all of these are kind of just great ways of really updating knowledge for students. And actually, these are many of the ways in which they, as they enter adulthood, will be engaging with financial institutions themselves. So in a sense, this is broader than just being an economics teacher. You're really dipping in a little bit here to also delivering some PSHE. one of the things that I've always really enjoyed doing in my teaching, and this really depends on the setup of your classroom. You can do this on notice boards or interactive whiteboards, or even just post-it notes stuck on a table, completely up to you. It's the idea of the fact wall, getting students to find interesting facts and nuggets and bits of data about a particular market so that they can share that with the rest of the group. It's really important as part of this Go APE acronym for evaluation, that evaluation can include evidence or counter evidence. So I've just put together this fact wall. It took about 10 minutes on key facts and figures to do with retail and commercial banking. You may want to simply pause the webinar at this point to take a quick screenshot or to read through that more carefully. But facts and figures are really, really good ways for students to add weight and value to a particular argument. Here's another fact wall that I put together, this time related to particularly the macroeconomic impact of financial markets. As you can see in there, there are facts and figures related to employment, growth, dynamic efficiency, investment, trade, and the fiscal balance. So again, linking in with as many macro objectives as possible. You could make your own fact wall or get your students started on a fact wall. I was particularly interested in looking at financial inclusion, and you'll find the website that's highlighted on the screen there quite a useful source of information, and actually quite shocking for people who perhaps are already quite well involved and integrated with financial institutions. So again, I'll just leave you to have a read through some of those facts and figures. With students, if you were doing this with students, you could perhaps get them to have a think about which ones they think are the most shocking or the most important or the most influential on the macro economy. It's up to you how you use these fact walls. So finally, some other teaching ideas. I promised earlier in this webinar recording that I would provide the link to a financial markets revision crossword, just so you can see roughly what it looks like. There's a bit of a screenshot of that on the right hand side of the page, and the link is provided on the left. It might also be quite fun to help your students write and conduct a financial survey. They could carry this out with friends, family, teachers, people that they work with, for example, and get them to find out what these people are doing in terms of pension provision, how much they save, how they finance property, for example, looking at how much cash their teachers might carry, what kind of people tend to use payment apps on their phone, that kind of thing. You can just really help to provide a firm grounding and make what can seem an abstract topic that is not relevant to your average 16 or 17-year-old a little bit more applicable. I think there's also lots of merit in visiting high street banks, talking to bank managers and the people that work there about their various products and their customers, and the various needs that they face. So that brings us to the close of this second Financial Markets Economics Teacher webinar from Tutor to You. As ever, if you have any thoughts, comments, questions, queries, or just generally nice things to say, please do drop me an email. You can reach me on ruth@tutortoyou.net. Hopefully we'll see you at one of our CPD events, either face-to-face or online, or our student workshops in the very near future.